Morning rush hour. Starbucks lights go dark. A handwritten sign reads, "Closed. Permanently." Inside, espresso machines sit cold while customers press their faces to the glass. 400 stores gone overnight. What happened to America's most familiar smell? Tariffs, inflation, and global rivalry just turned a $119 billion empire into a warning label. And halfway across the world, China's Luckin coffee is opening 2 stores for every one Starbucks that dies, pouring cheap lattes into the vacuum America left behind. This isn't just about coffee anymore. It's about who controls the world's morning routine. The claim circulating online that 400 U.S. stores are closing because the company is running out of cash conflates 2 ideas. A number big enough to shock and a thesis that the cause must be crisis. Starbucks filings and press statements frame the move as selection, not surrender, closing underperformers while upgrading others. That explanation could be rational or self-serving. Both can be true at once. The relevant test is whether the shrink fits a broader pattern visible in audited data softening U.S. demand for premium beverages, slower throughput at busy dayparts, and negative comparable sales over recent quarters. Wall Street reporting notes, the cuts are the most significant retrenchment since 2008 and followed an internal profitability review nicknamed Project Bloom. Those are observable actions, not slogans. Now look east. For a decade, Starbucks staked its international growth narrative on one market, China. That bet has been challenged by a pricing knife fight Starbucks says it doesn't want but can't fully avoid. In 2024, local rivals, most visibly Luckin, expanded faster, blanketed second and third tier cities, and used app-driven coupons to normalize single-digit yuan drinks. Reuters reported Luckin's 2023 China revenue at about 24.86 billion yuan, or $3.45 billion, surpassing Starbucks' comparable sales in the country. The response in 2025 selective price cuts of about 5 yuan on iced and tea-based drinks, plus new lower entry points, a tactical move that acknowledges the reality of the battlefield. Market share estimates from Euromonitor, relayed by Reuters Breakingviews, show Starbucks, China share sliding to roughly 14% in 2024 from the mid-30s 5 years earlier. This is not a morality tale, it's arithmetic. A simple explanation, America shuts, China takes over, is neat and likely wrong. The more defensible hypothesis is that 2 forces are converging, a North American network prune after years of expansion and a Chinese price war that erodes premium positioning. In the U.S., Starbucks is closing underperformers while promising to reopen the growth spigot in 2026. In China, it is exploring strategic options including selling a minority stake to a local partner while retaining control. Neither move implies capitulation, both admit pressure. The load-bearing fact is the market share math and the revenue crossover in China, where cheaper rivals grew faster rather than a single executive soundbite. There's a second claim to test that policy shocks rather than competition or execution explain the closures. In 2025, Washington escalated tariffs on a range of Brazilian goods. Brazil's government says President Luiz Inácio Lula da Silva asked the White House to lift an additional 40% surcharge during an October call, after the U.S. raised some rates to 50%. Reuters reported that Brazilian coffee exports to the U.S. dropped sharply after the hikes, with roasters paying more to replace supply. If you accept those facts, it follows that a retailer dependent on imported beans faces higher input costs unless it hedged perfectly or passed prices through to customers with no demand hit. But cause and effect are rarely clean. Coffee prices also respond to weather, harvest cycles, shipping costs, and currency. Tariffs are part of the picture. They are not the whole picture. What is clean is dependence. The United States grows only a sliver of its coffee domestically, mostly in Hawaii, and that production is far below national consumption. USDA's Economic Research Service notes domestic output covers well under 1% of what Americans drink. The remainder is imported, heavily from Brazil, Colombia, and Vietnam. That structure makes the retail price of a latte sensitive to foreign harvests, exchange rates, freight, and trade policy. When any of those shift, a chain with millions of drinks per day must rerun its cost stack: beans, dairy, syrups, cups, lids, labor, rent, and find room. The gaps show up first in stores with thin traffic or high lease costs. Global supply conditions have not been calm. The USDA's June 2025 World Markets and Trade Update projected record world output at 178.7 million bags. Yet ending stocks remain tight as consumption also set records. The International Coffee Organization's Composite Price Index rose more than 90% over 2 years. Tight stocks and higher reference prices lift the floor on green coffee costs, no matter what one company does. Put differently, even without tariffs, beans weren't cheap. Add tariffs and the floor is higher still. The strategic choice becomes either to raise menu prices and risk demand or to protect ticket values and compress margins. Neither option feels good at scale. North America's cafe map is uneven. Some suburban drive-thrus print money while some urban cafes struggle with lower footfall and higher wage and security costs. A 1% shrink can look surgical at HQ and brutal on a block that loses its third-place gathering spot. The company says many baristas will be rehired as redesigned cafes open, and that over 1,000 locations will be uplifted with warmer design and higher staffing at peaks. That is an assertion of intent. The results will show up in wait time metrics, same-store sales, and partner turnover. Until then, the observable reality is plywood and transfer offers. Meanwhile, China's cafe war keeps resetting price expectations. When a rival can profitably promote 9.9 yuan drinks at national scale, every competitor's perceived value shifts. The Starbucks defense has been brand, ambiance, and consistency. The third place where a seat costs more than the drink. The counter is mobile-first speed and relentless novelty at a lower price point. Reuters' on-the-ground reporting made it explicit. Even as the Starbucks insisted it would not join a price war, it was dragged into discounting through coupons and targeted deals. Once customers internalize a new reference price, raising it back is hard without a new product story. One more contested point. China is taking over the coffee empire. That, overstates and misframes things. There really is no single empire, and having a bigger share in one country doesn't mean you control the whole global category. What's actually measurable is that local Chinese chains collectively outsell and, well, out-open Starbucks in China. Starbucks' market share fell by roughly half over 5 years. That's a big deal strategically, because China was the growth pillar that was, modeled in investor decks. If the return profile compresses there, management has to either sharpen the value proposition, accept lower margins, find a partner, or re-weight the portfolio. The company is actively sounding out investors for a minority stake in China. Bidders' talk of valuing the unit around 10 times 2025 EBITDA suggests a market willing to underwrite the next chapter at a price. So, what about the rest of Asia? If lower-cost, mobile-native entrants keep scaling, the premium cafe model faces a choice lean harder into experience, which means larger, slower, pricier, or re-engineer for speed, making things smaller, faster, and cheaper. The 2025 U.S. plan, fewer underperformers, thicker staffing where demand is real, store uplifts, and capex toward throughput, implies a bias to experience plus efficiency, rather than, a pivot to rock-bottom price. That lines up with Starbucks, but it runs head-on into consumer trade-down. The real measurement will be in-line length and app throughput at 8:15 a.m., not in slogans about returning to our roots. Does policy tilt the playing field in China? Local subsidies and platform promotions definitely lubricate discounting, but the main driver seems to be competition among domestic chains with lower cost structures and denser delivery networks. Western brands can compete, but only by localizing menus, simplifying SKUs for speed, and tightening cost per ticket. Price moves in June 2025. 5 yuan cuts on popular iced and non-coffee drinks signal the brand understands the entry ramp Chinese consumers expect in the afternoon daypart. The open question is whether Starbucks can defend a premium for its core coffee drinks while still meeting the market on the non-coffee side. Stateside, the tariff channel is worth keeping an eye on. If the U.S. keeps 50% rates on a wide set of Brazilian goods, importers will keep paying more for green coffee unless supply chains reroute. Reuters reported a steep drop in Brazilian shipments to the U.S. after the hikes. That can tighten spot availability and force roasters into higher cost origins or grades. There's no free lunch here. Either the consumer pays more per cup, the roaster eats margin, or the retailer trims labor and hours, or, some mix of all three. Blaming any single lever for a nationwide footprint change just simplifies a system that's actually built on a lot of moving parts. Employees are the first to feel the system's choices. Closed cafes ripple into logistics with fewer deliveries, facilities with fewer maintenance tickets, packaging, with fewer cups, and construction, with fewer remodels today and more tomorrow. Starbucks says the closure wave is paired with a remodel wave. Suppliers will find out which order book shows up faster. Union questions will sharpen in markets where closures concentrate, and investors will watch whether remodels lift comps enough to justify the capital. In all cases, the scoreboard is quarterly. For viewers trying to separate narrative from noise, 5 touchstones help. First, closures are documented, sizable, and framed as a 1% net reduction for fiscal 2025, not an existential retreat. Second, China is still the second largest market, but Starbucks lost share as lower-priced rivals scaled. Price cuts confirm the pressure. Third, U.S. coffee is import-dependent. When tariffs hit Brazil or when global stocks tighten, bean costs rise. Fourth, competition and execution. Menu mix, wait times, staffing. Explain as much as macro policy. Fifth, management is testing structural answers in China via potential minority investors and in North America via network pruning and store upgrades. Those are the levers they control. If you're looking for a single takeover, you won't find it in the filings. What you can find is momentum, rivals in China normalizing cheaper tickets and faster service, and a U.S. operator trimming to defend returns. When momentum compounds, it feels like inevitability. It isn't. A price floor can move with policy. A price ceiling can move with product. A cafe's fate can hinge on 20 seconds of queue time. So the question is not whether a brand is finished, but whether its next choices reprice the category in its favor. If an American company built a premium habit on patience and place, and a Chinese competitor taught a generation to expect speed and discounts, which expectation travels better across borders in the next 12 months? The quiet room or the cheap fast cup? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.